America almost went bankrupt. In October 1907, the nation teetered on the edge of disaster. Millions of dollars vanished overnight. Banks collapsed. Stock prices plunged. Ordinary Americans, who had believed their money was safe, discovered it could disappear in hours. People ran through the streets clutching passbooks, their faces pale with fear. Businesses that had thrived for decades shuttered their doors. Families argued over last pennies. The financial system of the world's most ambitious young nation was cracking, all because the invisible pillar of trust had collapsed. At the start of the 20th century, the United States was booming, yet dangerously unbalanced. Cities grew rapidly, fueled by industrialization, railroads, and waves of immigration. Factories churned out goods at dizzying speed, while the stock market reflected boundless optimism. Speculation was rampant. Copper, steel, and cotton were in high demand. Investors borrowed heavily to buy stocks on margin. Beneath this prosperity, structural weaknesses festered. The country had no central bank. Private banks and trust companies operated independently, relying solely on reputation. One misstep, one failed investment, one rumor, and the system could collapse. The first spark came from the Knickerbocker Trust Company, one of New York's largest and most respected institutions. It had overextended itself, heavily invested in speculative ventures. When senior partners resigned, amid fears of insolvency, panic erupted. Depositors lined the streets, demanding cash. Lines stretched for blocks. Families fought over last pennies. Merchants shuttered stores, fearing collapse. Even wealthy investors discovered that reputation alone could not protect them. Money was only as secure as the confidence behind it, and confidence had vanished. Panic spread faster than any official announcement could control. The stock market reacted violently. Prices collapsed as investors scrambled to liquidate assets. Brokerage houses, leveraged to the hilt, were caught in a cycle of forced sales. Margin calls wiped out individual investors overnight. Businesses froze. Factories slowed or shut entirely. Rumors of bankruptcies escalated into hysteria. Panic fed itself, growing like wildfire. The effects rippled far beyond banks and brokers. Railroads struggled to secure operating capital. Mines failed to pay workers. Commodities like copper and steel plunged, devastating industrial investors. Regional banks, reliant on New York for liquidity, teetered on insolvency. Farmers who had borrowed to plant crops suddenly found themselves without access to credit. Across the country, panic infiltrated homes, factories, and farms alike. Money had become a weapon, and everyone was defenseless. Ordinary Americans experienced the panic in deeply personal ways. Families lost life savings. Merchants who mortgaged property to invest saw everything vanish. Children overheard arguments about unpaid debts and vanished inheritances. Shopkeepers shuttered doors. Factory workers faced eviction. Even school teachers' pensions, tied to local banks, became worthless overnight. Panic was tangible and relentless. Newspapers fanned the flames. Headlines screamed of financial ruin. Accounts of bankruptcies and failed banks were printed daily, sometimes exaggerated by rumors. Investors acted not on facts, but on fear amplified by media. Panic became contagious. Money, the lifeblood of the economy, now flowed only toward survival, and every corner of the nation felt the strain. Amid this chaos, one figure emerged whose actions would determine whether the nation survived: J.P. Morgan. Panic, he knew, was lethal. Without decisive action, the country could collapse. Morgan summoned rival bankers to private offices, convened emergency meetings, and pooled millions in private capital. Every move carried the weight of the nation's future. Bank by bank, rumor by rumor, confidence was painstakingly restored. Morgan's strategy was both financial and psychological. He understood that money alone could not stop panic. Perception and trust were equally critical. If the public believed banks were safe, they would act rationally. If doubt lingered, chaos would continue. Morgan reassured hesitant bankers, coordinated emergency liquidity, and monitored public perception personally. Each decision was calculated. One misstep, one false rumor, and the system could collapse completely. Every hour, the nation balanced on a knife's edge. Families continued to suffer. Mothers wept over empty cupboards. Fathers argued over unpaid bills. Children watched the destruction of their parents' dreams. Merchants who invested cautiously faced ruin. Communities feared economic collapse. Panic was no longer abstract. It was real and relentless. Trust companies, less regulated than banks, had fueled the speculative frenzy. Investors borrowed aggressively to buy stocks on margin, assuming the boom would continue indefinitely. Loans backed by industrial or mining ventures turned worthless. When one institution faltered, others were dragged in, creating a chain reaction. Panic spread beyond Manhattan. Chicago, Boston, Philadelphia, and smaller cities faced secondary crises. The nation was exposed to the domino effect of a financial system built on confidence alone. Morgan's interventions were meticulous. He coordinated rival financiers, negotiated capital infusions, and guaranteed liquidity. Rumors were addressed directly. He visited banks in person, speaking to anxious directors and ensuring public perception aligned with reality. Without his combination of authority, capital, and strategic diplomacy, the financial collapse would have been total. Even as banks stabilized, human suffering continued. Families faced ruined businesses, merchants lost properties, workers lost wages, communities questioned the system that had failed them. Children learned that even safe money could vanish. The psychological impact lingered for decades. J.P. Morgan understood that saving the nation required more than capital. It required authority, timing, and unflinching resolve. He brought together the city's leading financiers, including rivals, in private meetings. With calm determination, he orchestrated emergency loans, guaranteed liquidity, and coordinated banks to stabilize operations. Each move was deliberate. One misstep could reignite panic. In a financial system where perception often outweighed reality, Morgan's presence reassured bankers, investors, and depositors alike. Meanwhile, the streets of New York were tense and chaotic. Depositors lined up for hours, clutching their savings. Shopkeepers shuttered doors. Factories slowed or stopped operations. Families argued over last pennies. Children watched in fear as their parents struggled to protect what little remained. Rumors of failing banks spread like wildfire, feeding panic. The crisis had become a human tragedy as much as a financial one. Morgan's intervention was methodical. First, he coordinated capital infusions to banks at risk of collapse, ensuring withdrawals could be met. Second, he guaranteed loans for essential industries, railroads, steel, and copper, to prevent a total halt of commerce. Third, he indirectly reassured the public through trusted media channels, countering destructive rumors. Each decision blended finance with psychology, as he knew that rebuilding confidence was as critical as restoring liquidity. Even as stability returned to the banking sector, the human toll remained profound. Families struggled to rebuild lives. Merchants who had mortgaged properties for speculative ventures faced long-term ruin. Factory workers endured wage delays or unemployment. Communities grappled with distrust toward institutions. Panic was no longer a theoretical concept. It had transformed into lived experience. The Panic of 1907 exposed glaring weaknesses in the American banking system. Trust companies operated with minimal oversight. There was no central authority to act as a lender of last resort. The money supply, limited by gold reserves, could not respond to sudden crises. The interconnectedness of banks, industrial firms, and trusts created systemic risk. The failure of one institution could threaten all. Policymakers recognized the urgent need for reform. Within 6 years, the Federal Reserve was established to stabilize liquidity, manage the money supply, and prevent similar panics. Economically, the panic slowed growth. Railroads delayed expansion. Factories curtailed operations. Commodity prices plunged, affecting both industrial and agricultural sectors. Regional banks struggled to fund loans, disrupting local economies. Farmers found themselves unable to finance crops. Merchants could not pay workers. Panic was systemic, touching every level of society. From the devastation, resilience emerged. Banks restructured, regulations improved, financial instruments evolved. Investors became aware of the dangers of speculative leverage. Economists began studying the psychology behind financial crises, recognizing that confidence, fear, and greed could be as powerful as tangible assets. New York slowly returned to normal. Streets that had been filled with screaming depositors and panicked brokers became quieter. Markets stabilized. Banks reassured clients. Businesses cautiously reopened. Yet the memory of the crisis lingered. Children who had witnessed panic grew wary of speculation. Merchants who had lost fortunes became skeptical of financial promises. The city recovered physically, but the psychological scars endured. The Panic of 1907 is more than an economic event. It is a study in human behavior. Money is not just numbers. It is trust, fear, ambition, and sometimes catastrophe. When these forces collide, consequences are swift and far-reaching. The story illustrates the delicate balance between prosperity and panic and highlights the extraordinary impact of individuals like J.P. Morgan, whose foresight and decisiveness arguably saved a nation. Lessons from the crisis extend beyond history. It influenced the design of modern banking, leading to stronger regulation, central banking, and risk management. Future financial crises, the Great Depression, market crashes, even modern volatility, echo the same pattern of human psychology at play. Greed, fear, and trust can create fortunes or destroy them overnight. Socially, the panic reshaped attitudes toward money. Ordinary Americans became cautious about speculation. Communities demanded greater oversight of banks and trusts. Political leaders realized the necessity of safety nets and emergency measures. The crisis was a collective trauma, teaching generations the limits of confidence, the dangers of over-leverage, and the consequences of unregulated speculation. In conclusion, the Panic of 1907 is a cautionary tale. It reveals the fragility of financial systems, the power of human emotion, and the role decisive individuals play in averting disaster. America's near collapse demonstrates that wealth and stability are never guaranteed, that trust underpins all financial activity, and that panic, once ignited, can spread faster than any government decree or banknote. From the ruins of the panic emerged the blueprint for modern American finance. The Federal Reserve was created. Banking regulations improved. Investors and institutions learned lessons still applied today. Confidence was restored but never forgotten. Families rebuilt. Markets recovered. The nation, having stared into the abyss, emerged wiser and stronger. The Panic of 1907 is not just history, it is timeless. It reminds us that money is both a tool and a reflection of human psychology. Greed, fear, trust, and ambition can create unimaginable wealth or destroy it overnight. Every financial system is only as resilient as the confidence that supports it. The events of those terrifying weeks remain a story of suspense, drama, and human emotion, where fortunes vanished, institutions teetered, and a nation faced its darkest financial hour, only to be saved by foresight, strategy, and courage. Even today, the lessons resonate. Financial systems still rely on trust, and history proves that when confidence fails, the consequences are immediate and devastating. The Panic of 1907 remains a story of suspense, drama, and human behavior. A human story, a financial story, and a warning for every generation.